Thank you all for joining us today. Good morning, everyone. For this session today, Summit is proud to partner with Cetera. Today's topic is Pandemics, Politics, and Presidential Election, Investing in 2020. Today, we will be discussing the financial preparations and ramifications ahead of the upcoming election. This session will cover key market drivers and 3 investment themes likely to drive the economy and financial markets for the foreseeable future. We do have the Q&A feature available, so you can submit questions through that option, and if there is time at the end of the session, those questions will get addressed. You may also email us any questions to marketing@yoursummit.com. I will display that email address again near the end of our session today. So let's get started. We have 2 guests joining us today. Our first is Mr. Gene Goldman. Gene is the Chief Investment Officer and Director of Research at Cetera Investment Management. He is responsible for the strategic direction and continued growth of the firm's research offerings. His role includes setting the vision for superior capabilities and enabling the delivery of objective investment advice. He provides day-to-day oversight of Cetera Investment Management with a focus on providing unbiased research about the economy and financial markets, asset allocation strategies, mutual funds, and other investment-related topics. Mr. Goldman has had more than 26 years of experience in the development of investment strategies, money manager research, and overseeing investment analysts. Mr. Goldman is frequently cited in a range of national media outlets, including the Wall Street Journal, Bloomberg News, the New York Times, Forbes, and Reuters, and he is a regular guest on high-profile networks, including CNBC and Fox Business News. He has been a featured or keynote speaker at dozens of industry events. Our next guest is Kaci Skidgel. Kaci is the President of Retirement Plans for Summit. Kaci is author of the book Path to the Summit, Strategies to Reach Your Company's Peak Retirement, and was acknowledged as one of the top women advisors by the National Association of Plan Advisors for 5 consecutive years, and more recently named by Financial Times as one of the top financial advisors. And now I will pass this off to Kaci to begin today's session.
Thank you, Megan, and thank you all for your time today. Thanks for being on with us. 2020 has obviously been a very interesting year, to say the least, and so we trust that your families and your companies are staying safe and healthy. I know for us at Summit, as an employee benefits firm, we are very high touch and really itching to get back out and be able to get in front of our clients and meet face to face. Well, we know how important relationships are. And so today I'm very excited and honored to be able to have Gene be our guest on the webinar. Gene, obviously your pedigree speaks for itself, as well as your investment strategy and research. And I'm certain that today will be excellent, as there's so much to actually cover. Our topic, pandemics, politics, and the presidential election, well, it obviously sums up this year with the passing of Supreme Court Justice RBG last week, the announcement over the weekend by President Trump, and then even what's going on, the debates Tuesday evening. I look forward personally to hearing what you believe is the impact to the markets these next several months and then beyond. So with that, we're looking forward to your comments, and anyone that does have questions, please use that Q&A or the chat, and we will make certain that we get to some of the questions toward the end. So Gene, passing it to you.
Great, thank you. Well, thank you, Kaci. Thank you, Megan. Well, good morning, everyone. Thank you for the time this morning. I'm excited. I think we're speaking for the next, 3 hours? So I'm looking forward to speaking to you for 3-4 hours, maybe. Just kidding. I do apologize in advance. I do say a lot of bad jokes, so I do apologize. But on a serious note, listen, I hope you're all safe and healthy. Clearly, while we're here to talk about politics and the markets and the economy, the important thing is really safe and health. Clearly, the pandemic has affected our economy, affected us, and just please be safe and healthy. So let's pivot over to the markets. Listen, this year, what a year it's been. And I know Kaci alluded to this, but just think about this. The S&P 500, the broad stock market index, fell 34% from February 19th to March 23rd. Unprecedented decline in the stock market so fast, so quickly. And then the S&P 500 rallied 50% from those lows. So you had a sharp decline and a sharp rally. And think about this, okay? Right now, we just finished the longest expansion in the history of our nation. Longest expansion, over 10 years. And we theoretically could have the shortest recession on record. So we go from the longest expansion to the shortest recession on record ever. This is it's an interesting year. If you think about economic growth, GDP, and GDP is gross domestic product, and it measures sort of the output of the economy. It fell 5% in the first quarter. And the ugly part about that number is that it just really reflected the last 2 weeks of March. So the economy, by us being shut down, the economy fell 5%. In the second quarter, the economy fell 31.7%. Really, really, really bad. But think about this. There's a website called the Atlanta Fed GDP Now. It's a data point where basically the Atlanta Fed gathers a bunch of data and says, okay, what's our best estimate for the third quarter for economic growth? They're saying this could come in at 32% positive. So again, longest expansion ended, the shortest recession likely on record. So this is as a backdrop. What I'll do is really cover three broad things. Number one, I really want to talk about the recent market volatility. September, we saw stocks fall about 4%. What really drove this volatility? Second of all, I'm going to talk about our three key investment themes for the rest of this year. And then third of all, I really want to discuss the election, so what we're thinking. We recently produced a commentary I think you'll find interesting, and I'll take some highlights through some slides. So let's talk about the recent volatility. So the stock market in the month of September, it sold off about 4%. And there were worries everywhere by people saying, listen, is this the beginning of a bear market? And a bear market, as we know, is basically a 20% or more decline from the top to bottom. We saw that back in February to March. And the question was, is this the beginning of the bear market? Our opinion, it's not. It's just a sign of a very frothy, a very kind of expensive market. So why was the stock market weak in September? There's a few reasons. First of all, when the Fed spoke, and the Fed is short for the Federal Reserve, so when Jerome Powell spoke a couple weeks ago, he came out and really just said, listen, the Fed is doing all it can, but it needs more fiscal stimulus. The market really kind of opened its eyes to say, wait, you don't have any more kitchen sinks to throw at this economy? And the Fed said, we basically do, but we really need the fiscal side. We need Congress to get itself in shape and really provide some type of stimulus. The market was a little bit kind of, tweaked about that. The other thing, it's a very small report, but it was very important. August retail sales numbers came in a couple of weeks ago. And why is this so important? Well, the August retail sales numbers weren't that great. They came in below expectations. But why is that so important? Is because this was the first month after the expiration of the Fed's additional unemployment benefits. So all of a sudden people are like, wait, the additional unemployment benefits expired and then retail sales came in below expectations. Where is the economy going? And then you add on what Kaci said, the passing of Ruth Bader Ginsburg, RBG. She passed away. And that was very important. First, it was very sad for the nation. But in addition to that, there was really the ideology that now, because there will be a fight in the Supreme Court in terms of who's going to be nominated in the nomination process, Congress would take their eye off the stimulus ball. And so again, this kind of added all of this uncertainty into the markets. For us, we believe it's just the market decline was just sort of the market removing a little of the frothiness. If you look at the markets, why we don't think it's headed for a bear market. First of all, there's too much stimulus. Okay, and I'm going to talk a lot about stimulus, but basically stimulus from both the Fed and from Congress. And stimulus, if you think about this, so the official, we shut the economy down around March 15th. Okay, March 14th or March 15th. By 8 days later, the Fed had already approved and already implemented a stimulus package. 8 days later. Think about it, 8 days later, during the great financial crisis of 2007, 2008, it was basically 2008. It took the Fed about 9 months to implement stimulus. We implemented stimulus in 8 days. That's good. The second of all is that earnings are being revised upwards for next year. That's good news. In the world of investing in stocks and the economy, if the economy is doing well, then all of a sudden companies sell more widgets, they sell more units, they sell more stuff. If a company sells more stuff, they have more earnings. If earnings rise, stock prices tend to move a little bit higher. So, I'm making some assumptions, but basically Earnings rise, stock prices follow. For next year, earnings are expected to rise about 26%. That's really good news. Also, the sell-off we saw in September, usually when it's a bad sell-off, when it's a lot of uncertainty, you'll see investors move into defensive sectors like utilities, like healthcare, like consumer staples. But what we actually saw was last month in September, some of the leading sectors were more cyclicals, like materials, like industrials. So at the end of the day, we feel that the September decline was not the beginning of a bear market, but it's really just kind of blowing off some of this frothiness for the market. So that's the recent volatility. And obviously, if you look at the markets today, we saw markets were up really high. Now, you look at the Dow, it's just turned negative as we speak. Dow is down 5 points. But again, volatility is going to be here for a while. So let me pivot over to my second point. What are our three themes, for the rest of this year? And our three themes are a U-shaped economic recovery, increasing market volatility, and the third thing is a shifting investment landscape. So let me kind of dive into each of these. And I do apologize, as Kaci and Megan know, I tend to go off on tangents. So please bear with me if I'm going into different tangents. But listen, our first theme is a U-shaped economic recovery. So what this means is that the economy has fallen, and then it slowly comes back up. And we have seen people talk about V-shape, and basically a V-shape is the economy falls and bounces right back. And yes, we did see the initial V. We saw this as evidenced by the huge jump in copper prices. We saw this in the rise of cyclical stocks. We saw this in strong survey data. Let me take a step back. Why is copper so important? Why do we care about copper? And listen, copper is so important. The average American car has about 40 pounds of copper built into it through wiring, through circuits. The average American home has about 400 pounds of copper. So copper is a real-time indicator in terms of how the economy is doing. Plus, China consumes about 50% of the world's copper supply, so it's a real-time indicator of how the Chinese economy is doing. So right now, copper prices are back to July 2018 levels. Why is that important? Well, that was the beginning of the U.S.-China trade war when copper prices sold off. So we are, at the end of the day, we are in a recovery. It's just that we don't think it's a V-shape. We think it's a little bit more of a conservative U-shaped recovery. Why is this the case? Well, first of all, the economic hit was so big. Think about this. During the height of the restrictions back in late March, 310 million Americans, 310 million of us were either in a shelter in place or they stayed home. If you think about that, that's 94% of the U.S. population. Also, the V-shaped recovery suggests that we get back to pre-pandemic levels by the fourth quarter of this year. We just don't see it because even from a numbers standpoint, and I went to school for engineering, so I love numbers, but if you look at the last 6 economic recessions, on average, it took us about 33 months to get from pre-recession back to post-recession, back to pre-recession economic levels. Again, let me say that again. It took us, on average, in the last 6 recessions, about 33 months, almost 3 years to get back to pre-recession economic levels. It just takes a while. The Great Recession back in 2008 took us about 68 months to get back to pre-recession levels. So again, it's going to take a while. If you look at the jobs picture, I think the jobs picture is a perfect example of this U-shaped economic recovery that we expect. Today, it's heartbreaking. There are 11 million people unemployed in America. 11 million people. At one point, we had 20 million people unemployed. And just to put this in perspective, during the largest expansion in history of the United States that lasted about 10 years, we saw about 20 million jobs created. We lost about 20 million jobs in about 2 months. So again, you can see the impact of the economy, the effect on the labor market. If you look at jobless claims, so jobless claims are people filing for the first-time unemployment claims. In the last 26 weeks, we've seen 22 of the last 26 weeks, we've seen over 1 million jobless claims being filed, over 1 million new claims in 22 of the last 26 weeks. Even this morning, we saw 837,000 new unemployment claims. Not as bad as a million, and it's not as bad as a million. And the good news is that it came in lower than expected, But let's just put this in perspective. Pre-pandemic, the high in jobless claims for 1 week was 637,000. We've been over 1 million now for 22 of 26 weeks, and we were at 837,000. And the markets cheered the numbers this morning. So all we're saying is that the economy is coming back slower than people anticipate. My favorite data point that kind of really explains this U-shaped recovery is TSA check-ins. So when we all go to the airport, if you go to an airport, you obviously go through TSA, you get checked in. Okay, earlier this week, at one point, we checked in over 800,000 people at U.S. airports. 800,000, that's a great number, because just think about this. Back on April 12th, we checked in only 90,000. So this is a 800% jump from just back on April 12th. Great news, right? But a year ago at this time, we checked in 2.4 million people. So all we're saying is this, listen, that the economy is improving, the recovery is in place. It's just a little bit slower than the markets are pricing in. We continue to expect a U-shaped recovery as opposed to the V-shape that the market's pricing in. So a lot of times, and I'm going to go off on a little tangent right now, but a lot of times you're hearing people say, well, maybe we're in for a very deep recession. Maybe we're in for an L shape. And economists and market strategists like me, we try to sound cool. We throw these letters in like U and V and K and L. And some people out there are saying, hey, we're headed for an L-shaped recovery. And an L shape is the economy has fallen, it's come back, but then it keeps kind of meandering, almost like a depression. And for us, we do not believe that we are headed for any type of depression or for any type of L-shaped recovery. The key thing here is that there's so much stimulus in the economy, both monetary and fiscal. So from a monetary standpoint, that's basically the Federal Reserve coming in and lowering rates. So let me take a step back. What the Federal Reserve does, the Fed does, is that if the economy starts to slow down, what they do is they lower interest rates. When they lower interest rates, credit card rates go lower, auto loan rates go lower, home equity loan rates go lower, and this theoretically stimulates the economy. From a fiscal standpoint, this is the government coming in and spending money on, increased benefits, on bailing out small businesses, on, again, a lot of this fiscal stimulus. But if you think about right now in the economy, right now we have about over $10 trillion of stimulus in this economy. It's unprecedented. Just to put this in perspective, this is over 1/3 of US GDP. So we have $10 trillion in the economy. So this is one of the reasons why we don't believe we are headed for any type of deep recession or any type of depression. Taking a step back, people talk about the Fed, and I love what the Fed is in, the Federal Reserve under Jerome Powell. And the Fed, as a reminder, they lower interest rates to help stimulate the economy. And everyone talks about the fact that we are at near zero interest rates. This is keeping interest rates very, very, very low. But one thing I want to talk about, and something that you can talk to your friends and to your neighbors, is what the Fed did that gets a lot less press, but which is much more important to the economy. This is simply what the Fed did, is that they improved market confidence via bond market liquidity. So I know this is a bunch of words, but listen, let me say it again. They improved market confidence by driving bond market liquidity. How did they do this? Well, back in March, okay, you saw what was going on in March. Basically, the economy was shut down. And the Fed saw that basically there was no lending going on. So what the Fed did is they really provided liquidity behind the scenes. Let me give you a very simple example. So there's a lending tool out there. It's called commercial paper. So commercial paper is basically used by companies to borrow money, borrow cash on a very, very short-term basis, usually about 30 days or so. And it's a great way for like a large company to borrow money because you don't need to put up any collateral. You don't need to put up a factory, a building, any of that stuff. All you do as a large, financially stable company is you say, I'm going to the commercial paper market. I'm going to borrow money on a short-term basis, probably for like some salaries or wages or something, some type of short-term debt expense that you have. So you go into the commercial paper market and you say, I'm going to come in and I'm going to borrow money for 30 days or less, and I'm going to support it on the basis of my financial stability. And this type of lending has existed for years and years and years. Companies have been doing this for a long time. Big companies do this, like anyone from, you know, Dell Computer to Microsoft to Apple, big, and I'm not giving recommendations on these companies, I'm just saying they do this. Big companies do this. But what happened when the economy shut down, these companies still needed to borrow in the commercial paper market. So they would go to their commercial paper lenders and say, hey, I need to borrow money again for 30 days. And these commercial paper lenders would say, hey, do you realize that we're having a pandemic right now? Do you realize that we are in the midst of a sharp recession? We're gonna let you borrow money from us. This is what commercial paper lenders would say. We're gonna let you borrow money from us, but we're gonna charge you a lot higher interest. We're gonna really, because we need to be compensated for the additional risk. So all of a sudden these big companies, again, Microsoft, Dell, Apple said, whoa, hold on for a second. Now that our borrowing costs are increasing dramatically for such short-term cash that we've been borrowing for years and years, we can't do this anymore. So then all of a sudden these companies said, you know what, we need cash on hand. So they started to max out their credit lines at banks. Credit lines at banks are very, very expensive. You know, just examples, Boeing maxed out its almost $14 billion credit line within a weekend. You know, GM did the same thing, $16 billion within 3 or 4 days. All these companies were coming in and maxing out their credit lines. And this stress spread out through the rest of the bond market. All of a sudden, high yield companies, okay? A high yield company is basically a company that, you know, it's a little bit more risky, but theoretically it pays a higher yield. So they're called high yield bonds. You know, in the olden days, people would call these junk bonds, but that's a taboo name now. It's high yield bonds. And these companies would go in and borrow money, but because they're a little bit more risky, there's a higher interest rate. These high yield companies went into the bond market and tried to borrow money, but all of a sudden, because of this commercial paper concerns, because of companies accessing the, you know, their credit lines, all of a sudden, high yield lenders said, hold on, we'll let you borrow money, but we're going to charge you 10% higher. So like on a Monday, a high yield company could borrow at 6%. On Tuesday, all of a sudden it's 16%. Now a high yield company is like, whoa, I'm not going to borrow money for 16%. Investment grade companies, higher quality companies, you know, same thing. They would go in and borrow money on Monday at 4%. On Tuesday, all of a sudden it's 8%. So again, super, super expensive. So what happened behind the scenes that doesn't get much press is that the entire bond market shut down. Companies weren't borrowing money. Companies were trying to tap in their credit lines. Companies couldn't get commercial paper. Everything froze up. There was one point, there was no borrowing for a couple of weeks. Companies could not borrow money. So this is what the Fed did. Again, this is the important thing that the Fed did. The Fed went in the middle of March as this thing was happening and said, listen, we are going to buy $700 billion worth of treasuries and mortgage-backed securities. And what they did is that they went to different commercial paper lenders' balance sheets, bank balance sheets, financial firms' balance sheets, and said, we're buying that bond, we're buying that bond, we're buying that treasury, we're buying that mortgage. This is what the Fed was doing, was buying all these bonds. What happens when you buy these bonds? The Fed goes in and they buy these bonds and they replace it with cash. All of a sudden, you're a commercial paper lender and you've got a ton of cash on your balance sheet. What do? In the law of supply and demand, you have all this cash, you start lending it out. And if you want more people to borrow from you, you start lowering your rates. So all of a sudden, rates started to drop really, really fast, really, really quickly. This worked out so well, so phenomenally well. 8 days later, when the Fed started doing it, they said, you know what? Forget $700 billion. That's just a drop in the hat. We're going to make this forever until the bond market is fixed. And they call this quantitative easing to infinity. So what happened through all this? Well, rates dropped dramatically. Borrowing costs dropped dramatically. The market really, really reopened. Let me give you an example. There's a company called Yum Brands. Again, any company I mention, I do apologize. I'm not making any recommendations. I'm just using these companies as what happened. There's a company called Yum Brands, and we know Yum Brands. They own, Kentucky Fried Chicken. They own Pizza Hut. They own, Taco Bell. A lot of these, fast food restaurants, and they are considered a high yield company because there's a lot of risk in that business. Well, Yum Brands, after the Fed did all of this behind the scenes, this improved the bond market liquidity. what Yum Brands did is they said, okay, we are coming to the bond market now, and we really need to borrow $500 million. We need to borrow it. The bond market said, heck no, you're not borrowing $500 million. You're going to borrow $600 million because we have so much money to lend to you. So listen, I know I went off to a tangent, but this is the importance of what the Fed did. Everyone, you see Jerome Powell speak on TV, you see the Fed talk about lowering interest rates. The most important thing that they did this year was really improve bond market liquidity to really open up the bond market. Because think about all the ramifications of the Fed not doing this. The bond market would slow down, everything would seize up. And again, the Fed did a great job. So again, I'm going to get off my soapbox, but again, people don't talk about this, but this is something that the Fed did that's so important. Okay, let me go back to the presentation. Sorry for the tangent. So number one, U-shaped recovery. Number two is increasing market volatility. So listen, we really believe the markets continue to price in a V-shaped recovery, that sharp V shape, as opposed to the U-shape, a little bit slower recovery. And the markets are trying to reprice where the economy is going. Our opinion is that the economy is moving forward, but it's going to be very choppy until we get to the end result. You know, basically, we're going to see a battle of tailwinds, so positive news, versus a battle of headwinds, a lot of negative news. And this is going to create daily volatility in the market. There's lots of things we can list for positives and negatives. The three key positives that we look at are this. Number one, you know, the economy was in good shape going into the pandemic. You can look at the consumer. We as consumers were in good shape going in. We also have very low interest rates right now. Number two, I've said this a few times, so much monetary and fiscal stimulus in the economy. Really, it's about $10 trillion based on our estimates. That's over a third of GDP. The third point, why we see some positives in the economy, these positive tailwinds, these things pushing the economy forward, is that we believe that we are past the low point in terms of the bad economic data. Economic data has gotten better and better and better. Slowly, but it has gotten better. Also, I think housing is such a strong component of this economic data. Housing is so strong and it has so much ramifications. Think about this. We saw a data point for the month of August that right now, home sales are on pace for 6 million sales seasonally adjusted for the entire year. That's a huge number. This is the highest pace since May of 2006. It's a huge number. Also, think about this. Home ownership of homes, home ownership has expanded dramatically. If you think about people under the age of 35, home ownership has risen to 40.6%. This is the highest since the third quarter of 2008. For people between the 35 to 44 level, it's risen to 64.3%, highest level since 2011. So why do we care about home ownership and home sales? Well, listen to this. If you factor in construction, home improvement construction, spending on furniture, spending on furnishing, appliances, it's a huge impact, positive impact for the economy. Just taking all that stuff, construction and spending and all that stuff for homes, added $862 billion to our economy in July. This is really good news. Okay, those are the positives. Okay, these are the things that we think are going to push the stock market and push the economy forward. These are the negatives that are going to kind of say, okay, investors are going to say, well, let me take some of this with a grain of salt. So what we see is these headwinds. There's three things. Number one, consumer spending and the virus's impact on consumer spending. As we all know, consumer spending is about 70% of the U.S. economy, and the virus is going to clearly impact consumer spending. And we're seeing this already. You're seeing a lot of signs. You know, right now, U.S. retailers, for example, are on pace to close 25,000 stores by year end. 25,000 stores. Last year, we only closed 9,000 stores. We're on pace to close 25,000 stores. Second of all, if you look nationally, right now, it's about 25% of office workers have returned back to their office. 25%. If you look in New York City, it's at 15%. So the ramifications are people aren't going to lunch, people aren't going to the local store at work. You know, if you're working from home, you're spending less money. And the third thing is this jump, the third thing around consumer spending has been a huge jump in personal savings. Think about this. In the month of July, Personal savings rose 17.8%. Personal savings, that's huge. That means people are saving more money because they are really concerned about the economy. Last year, personal savings averaged 7.6%. For the month of July, it's about 17.8%. So number one is the impact of the virus on consumer spending. Number two is just earnings and valuations of the stock market. So I talked about this before. Remember, the economy is doing well. All of a sudden, companies sell more widgets, sell more units. They increase earnings, and if they increase earnings, their stock becomes more attractive, and people start to buy their stock. So earnings drive stock prices. And I know, again, I made some assumptions, but earnings drive stock prices. So listen, when you think about the stock market today, stocks have rallied about 50% since the March lows. But in 2020, earnings are actually down about 18%. So if you think about what we look at the PE ratio, the price to earnings ratio, it's a way that we look at to value the stock market. So the price earnings ratio is the price of the stock market divided by earnings. So the price is going up 50%. Earnings are down for 2020, expected to be down about 18%. What you have is a higher PE ratio, a higher valuation. So today, the PE ratio of the stock market is about 22 times forward earnings. Is that good? Is that bad? It's pretty high. The 5-year average is 16.9. The 10-year average is about 15. Valuations are pretty high. Valuations can be higher because we have much lower interest rates. We have very little inflation. But with a PE ratio of 22, we are pricing in absolute perfection in the markets. So this is why recently you've seen markets have gotten a little bit kind of jittery about the uncertainty around stimulus. The third thing that kind of concerns us as an overhang, and it's going to likely create market volatility, is the November election. So, there's a big discussion going on about the election. Will it be contested? And it makes sense. It's a good question because we expect a surge in mail-in voting. We expect, we've seen a lot of criticism about the process. Think about this, okay? The election is on November 3rd, okay? The Electoral College meets on December 14th. That's 6 weeks. So that's 6 weeks for the Electoral College to figure out and to count all the ballots. And it seems like a long time, right? 6 weeks to count all these mail-in ballots. The answer is no, it's not a long time. Think about this. In some states, we will see at least anywhere from 30 to 40% of votes will be via absentee, via mail-in ballots. Even think about New York. Okay, so New York State, they certified the June primary results not until August. It took a few months. And what happens if a state submits their results 95% counted on December 14th when the Electoral College meets? What happens? And the candidates are very close. So again, there's a lot of uncertainty, and I'll talk about elections a little bit later. But again, a contested election is a big market overhang, and you can see this in the stock market in terms of volatility pricing. You see there's a huge jump in expected volatility for the month of December around this. So again, I'm still in the second theme, but our second theme is increasing market volatility. The markets are going to weigh these positives, weigh these negatives, and kind of search for a direction. The result is increasing volatility. Our most likely outcome is that we will see a correction in the market. A correction is a decline in the stock market by about 10% or so. And I know a correction sounds scary, but at the end of the day, a correction happens on average about once every 13 months in the stock market. And a correction is a useful way to remove some of the market frothiness. So first theme, a U-shaped recovery. Second theme, increasing market volatility. Our third theme, and I'm going to go a little bit faster through these, is a shifting investment landscape. So whenever we've had a recession in our economy, we've always seen a change in market leadership. My favorite example is the early 2000s. So coming out of Y2K, coming out of the tech bubble, stocks, tech stocks were very, very expensive. Nothing happened with Y2K. All of a sudden, there was a big sell-off in tech stocks. So for most of the 2000s, technology was actually one of the most underperforming sectors relative to the rest of the market. 2008 happens, the recession happens in 2008. All of a sudden, coming out of the recession, we have fewer people working. Companies were spending more money on technology to improve productivity. And technology became a boon, and we've seen technology be a market leader for the last 10 plus years. Same thing coming out of this recession. We expect a shift in market leadership, driven really by a widening market breadth. So right now, and I'll explain what this means, but basically, we have a very narrowly focused market, and you've seen this in the press, that basically these so-called FANG stocks, and then, I'm not going to list their names, but you know who they are, those big stocks, these big stocks benefiting from working from home, staying at home, have really led the market higher. Think about this. The S&P 500, that broad market index, is up about 4% this year. FANG stocks are up about 47% this year. If you take out the FANG stocks, the stock market is actually down about 6%. So it's a very narrowly focused market. We expect market breadth to widen, and we expect other parts of the market to actually do better. So what this means for us is that we expect a rotation into other sectors that have historically done well coming out of a recession, like financials, like industrials, like materials. We do expect these sectors to lead on a go-forward basis. We also expect value stocks to do better than growth stocks. You think about technology. Technology is the biggest sector within growth. And year to date, technology is growth is outperforming value by about 35%. We haven't seen this number this high since the fourth quarter of 1999 during the tech bubble when this spread was 19%. So all we're saying is that it's not going to just be a large growth or a technology-driven market. What's actually going to be is just other parts of the market are going to lead us higher. So as I wind down this part, listen, 3 themes: a U-shaped recovery, number 2, increasing market volatility, and number 3, a shifting investment landscape where we'll see other asset classes like small caps and values and other sectors do well, like financials, industrials, materials, healthcare will do well. So those are our 3 broad themes for the rest of this year. Let me shift gears a little bit and I'm going to share my screen. So hopefully most of you dialed in via Zoom. Let me share my screen with you really quickly. And what I want to do for the rest of our time together, and thank you, I know we still have another 5 hours left together, but thank you for bearing with me. But I'm just kidding. I have another like 5 or 10 minutes. You guys are probably sick of my voice already. But let me shift gears a little bit and talk about the upcoming election. And what I have here is some slides that we produced from a market commentary that Summit Financial Group has access to, and I'm sure some of them have shared it with you before. But what I want to do is talk about the election, and we've called it really "Don't vote with your portfolio," and it's important because it's important, and it's the conclusion of what I'll say at the end about the election. So for this PowerPoint, for this presentation, I'm going to discuss 3 things, okay, in a very, very objective manner. Because, as you can see, I'm stumbling now because talking about politics, you got to be very nimble because I'm truly very, very independent. But again, what we want to do is just lay out everything on a very, very objective manner. So I'll discuss 3 things with you. Number 1, the current landscape. Number 2, key factors that could decide the election in November. And number 3, probably the most important thing, is what are the investment implications? So let's start with the election landscape. We know this, but let me make sure we're all on the same page. To become president of the United States, you need 270 electoral votes. If you look at this map here, those states in blue have generally leaned towards Democrat, and based on polls, based on history, they're more Democrat-leaning states. The red states are Republican states, as we know, but the most important states are the swing states, these purple states, anywhere from from Florida, Pennsylvania, Ohio, all the way through Maine. These are the swing states, and these are the states most likely to swing the election in terms of President Trump or in terms of Biden. So what is likely to swing these swing voters, okay? And there's many factors out there. For us, the most important factor is simply how has the stock market done? It's really simply stock market performance. Sorry, I do apologize for the loud here. Stock market performance. So think about this. If the stock market is doing well, the incumbent tends to do well. If the stock market is doing poorly, the challenger tends to do well. So in the years that the incumbent won, on average, the stock market returned about 10.1% that year through election day. And you can see when the challenger has won, the stock market has really struggled relative to the incumbent, only up about 3%. Another factor beyond stock market performance is the economy. In particularly, is it the improving job market, consumer sentiment? These are all very, very important to the incumbent. And I think this tomorrow, yeah, today's Thursday. So tomorrow, Friday, we are going to get the payroll report, the employment report. This is going to be the last payroll report before the 2020 election. It's going to be a very important report. People are going to watch this very, very carefully. I think estimates are for about 850,000 new jobs created. This is going to be a very, very important report because, again, it's something that either President Trump or Biden can talk about in terms of their election prospects. As part of the economy, again, there's many factors for the economy. You know, there's obviously the improving job market, consumer sentiment, of course, as I mentioned before. But the other part is the recovery taking hold? Is the recovery improving in the overall economy? And for us, you know, this recession, as I've kind of alluded to, it's a very different recession. You know, it's a supply shock and demand shock at the same time. Demand shock was impacted by the virus, by the pandemic. Supply shock was impacted by the sharp drop in oil prices, the sharp drop in the sharp increase in oil supply, driven by weaker demand. So all of this has really created a very different type of recession. And what we did is we wanted to look at economic data that's really very different than past recessions. So what we did on this slide here is that we created what's called our social distancing dashboard. And what it does, it looks at 14 high-frequency real-time data points to say, how are we doing on almost a real-time basis? It looks at TSA check-ins, which I talked about before. It looks at mobility. It looks at restaurant reservations. It looks at you know, people walking around, mortgage applications. Excuse me. It looks at 14 factors. And as you can see, what we've done is anything that's red, it's declining. Anything that's green is improving. Most of the factors are still well below pre-pandemic levels. So again, this ties to our U-shaped recovery. But again, this is something that we're watching in terms of where the economy is going to help decide where the election will go, either to Trump or to Biden. And of course, there's other factors, including the vaccine, China trade war, and then any additional stimulus between now and November 3rd. Okay, so the third part I want to cover is just the fun stuff, is the investment implications, okay? What should I do? What should I invest in? How should I allocate my portfolios? And one of the most common questions we get from clients like you is, you know, there's a lot of uncertainty around the election. Should I hedge my portfolio? And the answer is probably not, okay? So if you look at this slide, okay, what we've done is we plotted the performance from election day to inauguration day. It's a short time period, but it's important. And regardless of who wins, market returns have been pretty similar. So when the incumbent has won, on average, the return has been about a positive 4.1%. When the challenger has won, the return has been about 2.1% on average. Here's an interesting data point, okay? So if you look at betting offshore odds, and I'm not going to tell you how I know about betting offshore odds for stuff, but you know, if you do happen to look at betting online offshore odds, there's a 55% chance of a Democratic sweep. That means Biden gets elected and the Democrats sweep Congress, okay? 55% chance. And some investors out there are a little worried because, you know, obviously there's many ramifications, which I can talk about later. There's some worries behind that. But in the 6 times since the end of World War II, when we've had a Democratic sweep, this has occurred 6 times. Prior to the election, the 3 months prior, the stock market has fallen about 2.6%. When we do have a Democratic sweep in these last 6 times, we have seen more market weakness, which is what concerns investors. But in every single time, 3 months later, the stock market is back to pre-election levels. So basically what I'm saying is that even in the worst case scenario for the market, a Democratic sweep, again, I'm not making a judgment, I'm just saying, according to the market, and we know that Republicans tend to be a little more business friendly versus Democrats, but if a Democratic sweep does take place, market returns tend to be back to pre-election levels by 3 months later. So again, it's not necessarily good to hedge your portfolio. And I'll talk about what to do in a second. So what are the implications of who wins? And there's many implications. So listen, and I'm trying to be very, very independent, okay? And it's a very objective way, but, you know, and I'm not going to discuss who is better or who is worse for the country. You know, really, you know, both parties have their own policies. Both parties want to implement their own policies. And we won't really know the long-term ramifications for some time. But here's sort of things that we're thinking. If Biden wins, okay, Some ramifications are he'll most likely eliminate the state and local tax caps. And basically this could reduce the demand for municipal bonds. He most likely will raise the minimum wage. Okay, he's talked about this many times. If he does raise the minimum wage, this will impact about 35 million U.S. workers. That's a lot of people. The problem is that it could hurt services businesses, because services businesses will see the brunt of these wage increases. There is some possibilities that he will socialize healthcare. We do think it's a little challenging, especially given our budget deficit right now, but that's something that he has alluded to. He's most likely going to undo some deregulation that President Trump did put in. He most likely will increase regulation on oil and gas companies, on banking, on financial services, on insurance companies. That sounds scary, but that's not a big deal if he's elected, because really President Trump's deregulation has not really proven to be a boon for these industries anyway. So I think it'll be a muted point. Which sectors are going to win if Biden wins? In our opinion, utilities are going to outperform, REITs are going to outperform because they tend to be a little bit less immune, or more immune to tax increases. We also think less cyclical sectors are going to do well. We do think larger companies are going to beat smaller companies because they are less sensitive to the economy in a Biden election. Now, if Trump wins, listen, we do expect for him to continue a lot of the same policies. More deregulation, more tax cuts. We do think tax cuts, if they are approved, will be less than they were in 2017 and 2018. Because again, the economy is still not on solid footing yet. We don't see him raising tariffs on companies, on Chinese companies. You look at what's going on with the U.S.-China trade war, and clearly China has not lived up to some of its, of its bargains, some of its things that they said they would do. Part of it is pandemic related, part of it is just because they aren't buying as much. And President Trump, in this, ideally, he would raise tariffs on these companies, but he has not. So then instead, what he's doing is actually providing more restrictions on businesses like TikTok, for example, things like that you're hearing more about. So what this means is that we do think cyclicals will do better in a Trump win. Smaller companies do well. We do think value sectors would do well, like consumer services, energy, industrials, and financials. So again, those are things we think will do well. I know I kind of went over this really quickly, but listen, there's a lot of generalizations about what will happen because things can change constantly. A lot of this is already priced into the market. The key things that we do know is that both want to tackle drug price inflation. So we'll watch that very carefully, regardless of who gets elected. Both want to be more strict in trade. I think Trump wants to really increase restrictions against China and some other specific nations. Think about this. Since 2017, 4 regions, the EU, Mexico, Vietnam, and Taiwan, have accounted for the entire widening of the U.S. trade deficit, which Trump has said he's going to target. So you might see more tariffs against those regions. Biden, in our opinion, is not going to reduce tariffs. There's so much growing anti-China sentiment in political parties today. We do believe he's not going to reduce tariffs. Even when he's asked questions about Chinese tariffs, he has sidestepped that question. But we do believe if Biden is elected, he will increase pressure on, more security on technology transfers, more financial restrictions. So I know I'm getting over my time, but I'm winding down a little quickly. But listen, the risks of the election, this is my key point. The risk of the election, it's not who's going to win, but the risk is if there's not a clear winner in the election. What happens, as I discussed before, if we have a contested election? What if results are delayed or disputed for a long time? If you think about this and keep this in mind, back in 2000, we had the whole hanging Chad incident where we saw election results were delayed for 5 weeks. Even during that tough time with uncertainty, the stock market only fell about 4.2%. And a lot of this was probably driven around the fading tech bubble. So markets are pricing increasing volatility. But again, these are things we're watching carefully. So my last point, what does this mean for you in investing in your portfolios? And listen, a lot can happen between now and the election. Things are changing. There's so much uncertainty going on. But the election represents just one factor for your portfolio. There's bigger factors we need to focus on, like the macroeconomic environment, like corporate earnings, like potential vaccine. I think those three things, the economy, earnings, and vaccine are going to weigh more importantly on stock market returns. So what does this mean for you? Focus on what you can control, and that's basically your own risk tolerance, the own risk that you're taking with your portfolio. Are you consistent with your long-term investment goals? And this is where it's so important. You need to continue to be in contact with Summit Financial, with your advisor. Continue to be in contact with them because things are changing so fast, so quickly. They need to constantly review your financial situation, your risk you're taking, again, to make sure it's consistent with your long-term objectives. We just finished the longest bull market in history. We just finished the longest expansion in the history of our country. Things are very different on a go-forward basis. Stay in contact with your advisor. So Kaci, with that, I did not take one breath during the entire 3 hours of speaking, and
yes,
thank you.
a drink, Gene. We are so thankful for this information. And really, I think, Gene, there were a couple of questions that have come in, and we want to encourage people, if you do have any questions, make sure that you ask. I mean, we have, Gene, both business owners on this as well as investors, personal investors that are on. And so we're helping both. I appreciate you saying get with your investor. We think get with your financial advisor because we think that's important. And we know that during this time is when we're getting the phone calls of people asking those questions. What should I be doing? How should I be investing? And I think some of your slides were just perfect in reminding people that right now isn't necessarily the time to make huge changes if you already have a portfolio in order and you've been thinking about the long term the entire time. Now, if you haven't evaluated your plan over the course of time, obviously that's something that you want to do. So I just wanted to ask you, Gene, overall, should people, I'm just going to ask one more time. I think I already know the answer, but should people be going to cash? Because that's a definite question that we get asked. Should they be more conservative and start to peel back? Those are some of the main questions that we keep hearing is, should I take some risk off the table, become more conservative, and wait till after the election and then get back in?
Sure, great question. So going to cash, okay, if you go completely to cash, that's really what's called market timing. This is what you're basically doing is taking your entire portfolio and saying, I am so scared, and I'm moving to cash. And that's called market timing. And there's an old adage out there that I like to quote. It's, listen, the Hall of Fame of market timers is a very empty room. Because there's stats and there's data out there that proves that market timing does not work because it just doesn't work. So what I would do instead, to your second comment, is really sit down with your advisor, sit down with the team, just to make sure, here's my portfolio, here's my risk, here's my thoughts, my concerns. Maybe it might mean, taking a notch down in terms of your being a little bit more conservative. Maybe it's, I'm feeling confident. Maybe it's being a little bit more aggressive, but every person is very different. You need to sit down with your advisor and get in front of them and say, here's everything I'm having. Here's how my life situation has changed. I have 5 more kids now. Well, you can't have 5 kids right away, but I have another child coming or whatever. Here's how my life has changed, and here's what I'm concerned about. So definitely get in front of your advisor.
Okay, perfect. And so another question that came in was, well, what if on the other side, I'm actually sitting in cash? What would be the right move at this time? What are the opportunities?
Yeah. So if you're sitting in cash right now, I mean, first of all, it's every day you're probably watching the stock market saying, why am I in cash? But again, it's similar. It's the other side of the equation. You need to look at your stocks, your bonds, your cash allocation to make sure that it's consistent with long-term goals. The longer your longer time horizon, the more you can be in stocks. So since 1933, the average annual performance of the stock market is about 9.3%. For cash, it's probably a lot less. So all I would say is, again, I'm going to say the same thing, but get in front of your advisor and really look to reallocate your cash to be consistent with your long-term objective. There are opportunities out there. There's some sectors that have really struggled. We do think some of the value-oriented sectors like financials, like industrials are going to do better on a go-forward basis. There's other areas, but you need to sit down with your advisor and kind of go through, here's what my concerns are, here's what I'm thinking on a go-forward basis.
Perfect. Thank you for that. It's a great, that's great information. And so another question is, you know, if I'm not talking to my investment advisor a lot, I haven't been having that time, is it a safe time? We've been getting this question actually quite a bit. You know, is it a safe time right now to change investments, to make that move with our money? Or should we be waiting until 2021? I even think of fund changes for retirement plan clients that we've had, you know, discussions of, do we wait or do we go ahead and move forward? I think you addressed this, but because that came back through, I wanted you just to expand on that a bit.
Yeah, I mean, I'm always a big fan of trying to find your best investment opportunities right away. So I'm not a big fan of waiting. You know, one thing in the back of your mind, you can think about, well, we will see more volatility pick up. You can see this in the futures markets pick up in December. There could be some more buying opportunities. There could be some more selling opportunities. Plus, near the end of the year, you know, you got to think about tax loss harvesting. I mean, I'm not obviously not on the retirement side, but you have to look at the tax loss harvest selling. Again, going back to my answer again, every person is different. You need to sit down with your advisor and go through, here's my situation, here's what I'm worried about, because it's hard for me to make a general broad statement. I can tell you some ideas that we want to be overweight or underweight, or, you know, China looks attractive from an investing standpoint. Emerging markets look attractive. International valuations are cheap, but the right allocation is based on you and your personal situation. And I can't help you with that. I can just say where we're seeing opportunities.
No, I appreciate that. I think that's very helpful. And another question that we often get is, should I be buying gold? Is now the time?
Well, my name is Gene Goldman, so that makes sense. I'm just kidding. I'm the king of bad jokes. I apologize. Everyone's probably like booing me right now. But so gold. Gold is very high right now. And the reason gold is high is because people are expecting a weaker dollar. The last time we had a recession like this was back in 74 to 75, where we saw a supply shock. Oil prices jumped dramatically on OPEC. We also had a recession. We had a demand shock. People weren't spending money. The ramifications were lots of stimulus. Basically, this weakened the dollar, and dollar weakened, gold, because it's priced in dollars, rallied. Same situation here. People are thinking that with the Fed having to pay, with the government having to pay for all the stimulus, there's two ways you do it. You raise taxes, or you issue more debt. You can't really raise taxes right now because the economy is fragile. So you increase more debt. If you raise more debt, this tends to weaken the dollar. If it weakens the dollar, it's a positive for gold prices. Again, lots of ramifications, but also a lot of this seems to be priced in already. This is why gold is hovering around the $1,900 to $2,000 level. It hasn't really boosted that much. So gold, you know, maybe as a part of a commodity exposure in a larger portfolio, maybe, but you know, I'm mixed on gold right now because I think a lot of it's already priced in.
Perfect. Okay. And I know that we're running out of time. And so we just encourage you all. I think I'm going to be passing it back over to Megan. I appreciated, Gene, you being very, making sure that you were very middle of the road. And I appreciated that. I really had wanted to ask you that question, who was going to win the election? You said I am independent. I'm going to stay right in the middle. And so I appreciate.
I can tell you, it's going to be someone over 70 years old.
There you guys have it.
How about that?
You were wondering who was going to win. It's someone over the age of 70. Thank you so much for being on with us today. I'm going to pass it back over to Megan.
Thank you.
Thank you, Kaci. I'd like to thank Gene Goldman and Kaci Skidgel for their time today and for sharing this valuable information with us. And we would like to thank you all for joining us for this session. Please be sure to follow us on social media. We have 2 webinars coming up next. Our next is on Thursday, October 22nd. That session is titled The Traffic Circle of MLA, ADA, and Workers' Compensation. And we will be joined by Grayson Johnson, Human Resources Consultant with Summit Financial Group. This session will be an educational, informational discussion about compliance and with FMLA, ADA, Workers' Comp. We also have a webinar on Tuesday, November 10th, titled Anticipating the Unexpected, featuring our investments team as we navigate how business owners, families, and their loved ones can be better prepared for life's unforeseen events. So please keep an eye out for more information on that. We also have COVID-19 resources available on our website, so take a look at that for more information. But for now, thank you so much for joining us. Have a great rest of your day and stay safe.